Good morning, everybody. Welcome to the Flow Show. Friday at last, pub time nearly. The way the markets are behaving, that'll be sooner than later, I think. Morning, Kay. How you doing?
Hi, TGIF. Hi, Ryan. Hello, everybody. Yeah, ready to hit the pub.
Yeah, we should do this show from the pub on a Friday, I think.
Hey, that's not a bad idea. It's a bit early though, 10:30 to start
Well,
drinking.
I don't know. Define too early. We all know from our city days of all the pubs that used to be open well through the night. If you went up Old Smithfield's Market, the old meat market, there
Yeah.
were several pubs in there open through the night. So yeah, I'm sure they're not hard to find. But anyway, right, today's show we're going to dedicate to talking all about the Putin-Carlson interview.
All right. See you next
Only
week.
joking, of course, before you all start clicking off. There's enough analysis out there. We've all had a big, long talk about it in the chat room and that. Purely from a market perspective, not much at all. Whether the market takes any consolation from the comments that he's not looking to invade anywhere else remains to be seen. But whether those comments are believed or not, that was probably the only thing that the market took for that. But let's see what the US make of it when they wake up in the cold light of day and see what the response is from politicos over there is. Might be something that jostles markets, but other than that, there's going to be enough analysis on that, so we won't go over that on the show today. What we will go over is what's happening elsewhere. Pretty much zero comments out of China. They're all busy down the pub as well for their New Year's Eve, shall we call it, or the beginning of New Year's. So the radio silence from those guys for a while, but they will be keeping an eye on markets. Don't you worry about that. BOJ's Ueda says there's high chances that accommodative conditions will remain even if negative rates end. So following up from Uchida and Shimizu, I think it was, just letting the markets know not to get too hawkish, slow and steady. They're not going to be rushing to hike rates to 5% anytime soon. Suzuki was out. I haven't heard from him for a while, speaking in Parliament. So some of the usual waffle, said it's up to the market to determine stock price levels, and then came out with the usual waffle on FX, needs to move stably in line with fundamentals, blah, 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 blah. Nothing of note from there. RBA's Bullock was speaking at like a Treasury Select Committee type thing, saying the RBA board is focused on bringing inflation down. The board hasn't ruled out a further hike, but neither has it ruled it in. Recent developments in inflation are encouraging, but there's still some way to go to meet the inflation target. Inflation doesn't need to be in the 2 to 3% band to consider cuts. Does see an opportunity to cut rates if consumption slows more quickly than expected. BOE's man was out, one of the hike voters at last week's BOE, said UK financial conditions have eased too much and UK inflation is close to but not back at the 2% goal. Some of the justification for why she still votes for hikes. The other hiker, BOE's Haskell, says signs of lower inflation are encouraging but insufficient. We need more evidence on reduced inflation persistence to stop calling for higher rates. But he said the February decision was finally balanced, but they wanted to wait a bit longer. I think we can infer from that if the next round of inflation numbers comes in much lower, and we see the other evidence, PMI, price inputs and that sort of thing, wages, generally all price components coming lower, that we're going to see a shift from hiking to neutral, at least from Haskell. So that'll be something to look at the next BOE meeting on the vote side of things. All that had the market cutting its rate forecast for this year. Now less than 75 pips for this year are seen in cuts from the BOE by markets. Over at the ECB, ECB's Wunsch says there is value in waiting to get more comforting wage data, and it's wage rises that are holding up rate cuts. Again, that focus on wages. ECB's Lane says that incoming data suggests that the process of disinflation in the near term, in fact, may run faster than previously expected, although the implications for medium-term inflation are less clear. So a little bit of a dovish tilt in those comments. Again, on the wages, still says there's still meaningful upside risks in the wage issue. ECB's Hawke Holtzman came out saying that there's a certain chance the ECB won't cut rates this year. It was part of a speech that he went. It was basically explaining what may stop them from cutting rates this year. ECB's Kestrel Kazak says monetary policy is working. Inflation has fallen strongly. He wouldn't be as optimistic as markets on a spring rate cut, but said 2024 is the year of rate cuts, but the timing is dependent on data. Money markets drilled down the chance of a April cut, and it's now less than a 50% chance of a 25 pip cut at the April meeting. They also lowered overall cut expectations for 2024 down to around 115 basis points from 120 basis points. So the market seemingly still coming around to the ECB's way of thinking. Over at the Fed, Barkin, he's been doing the media rounds a lot recently. He must have pulled the short straw for February. Says economic data has been remarkable across the board, but that said, I'm cautious about the accuracy of numbers at the turn of the year. He cited that there's a lot of seasonality in those numbers, or can be a lot of seasonality in those numbers. So he won't take too much of a signal from any 1 month at the moment, but also said there's no objections to reversing the course on rate cuts if needed. Fed Collins let us know where her dot sits, saying that her baseline for rate cuts this year is similar to the 3 cuts or 75 basis points in cuts at the last FOMC meeting. Yellen, she was out speaking before the bigwigs, saying that the Financial Stability Oversight Council has discussed commercial real estate at almost all recent meetings, and said it's obvious there's going to be banking stress and losses associated with commercial real estate. She then put her central hat back on by saying the Fed's preferred inflation gauge is running at exactly 2%. Kay, what does she mean by that? Because if the Fed's preferred inflation gain is PCE, it's running at what, 2.6, 2.5?
Yeah, it's actually, and if you look at the 3 on 3 and the 6 on 6 months, we are already there. I don't know what her measure is. I mean, I was a bit surprised that she actually spoke so open about it. I guess that's her prior role as Fed governor or FOMC head that came back. She has to take care of the overall coffers. Not, of course, they want to see inflation at some level, but I don't see why she, and it's not the first time, by the way. She already said that once before, but she seems to be going side with the majority of the Fed right now, saying that it's not enough just to take the direction or to tip it there and to tap it there, and it has to stay there. It looks as a little bit of a hint of that. But then again, we only, well, I didn't watch all of it, but we only get the headlines, right? We don't know what the question exactly was.
Yeah.
Those people are asking questions to different officials, which have nothing to do with those officials' jobs as well. So it might have been just a one or the other odd question, and that's it.
Yeah. I'm just thinking, haven't we got? Isn't Powell due soon in one of his like Humphrey Hawkins types things? Because it's it's biennial, isn't it? Those appearances.
It could be. We have to take a look at the calendar. Perhaps it could be that it's soon. Yeah. It's rings a bell.
The other one's usually in June. Yeah, the other one's usually in June. I think the middle of the year. So he must be due one. Anyway, that's just a thought that popped into my head. But yeah.
Yeah.
Right. Obviously, I'm going to get your input from this one as well. Banxico left its rate unchanged yesterday as expected. Let's have a quick look at the numbers, because if I've still got them up here, because inflation, headline inflation came in as expected, 4.88%, which was higher than last month. The core number month to month came in a bit hotter than expected, but down. Some of the other inflation bits and bobs came in a little bit on the sticky side, shall we say, but they left their rates unchanged. Everyone picking up on the fact that they removed wording in the statement about holding rates for some time. They said that the balance of risk for the trajectory of inflation within the forecast horizon remains biased to the upside, not the downside, the upside. And I read through the statements this morning when I was doing my notes. They took out that line about holding rates for some time, which some took as dovish, but these two comments I picked out could be construed as not being as dovish. It said in the next policy meetings, it will assess, depending on available information, the possibility of adjusting the reference rate, but they didn't give any hint of direction.
Yeah,
they said the actions will be implemented in such a way that the reference rate remains consistent at all times with the trajectory needed to enable an orderly and sustained conversion of headline inflation to the 3% target. Does that sound like they're leaving the door open for hikes just as much as cuts?
Not for me, no. I think that's, as I said yesterday when it came out, that's not a pivot, but it's like a half, half or a quarter of a pivot, if you want. No, if you look at the rest of the Latin American countries, and if you look at the inflation elsewhere, I don't think that hints at a hiking more. But inflation is at in the fours, and the rates are at 11.25. They're always going to remain higher than others, right? Especially in the majors. They are not going to cut to 3 or 4%. That would be I don't think that's in the cards. But no, I do think that it's a little bit of a shift more towards the unhawkish side of things. But it's a fact that they didn't change the rates. So to me, if I look at both CPI and the Mexican and the Banxico combined, there's very little reason to actually trade. Now, the market has taken it also as a bit dovish, but then if you look at it in percentage-wise, it's still a small move, right? We're returning around 7.11, 7.12 when it came out. Well, 17, sorry, on the dollar mix, 17.11, 17.12 when it came out. Went up to 17.16 on those lines, and here we are, 7.13. I mean, taken in percentage, that's a 0.2, 0.3% move, and bye-bye. Your euro dollar on a data on a central bank moving 20-30 points. That's the impact that it had, and here we are, and because at the end of the day, it's still an 11.25% currency, and it's leaning in between emerging market and the US right now. So thanks to their nearshoring, yeah, I mean, I'm not. I didn't see too much of a trade in it. Let's put it that way.
Yeah. I wasn't saying they're turning back to hikes. It sounded like they weren't fully closing the door on hikes. It wasn't slammed shut like we've heard from some of the other banks that they don't foresee any need to hike further. But anyway, that's the way different people read different things. But anyway, yeah, thanks for that, mate. That's actually it from headline front. A bit of a quiet one. I don't know if you've got anything else you want to share.
Yeah, there's a couple of things. There's one of them is a bit of an alarming. How shall I say, an alarming article about the Chinese property crisis. About the spillover effects, and that came from the Straits Times, the Singaporean newspaper. I don't know if they took it over from somebody else. It could be, but I saw it in the Singaporean Straits Times, and talking about sales offices and big buildings going on sale elsewhere in the like, for instance, in Canary Wharf, and also in the States and in other countries. I think there's one in France as well, about from the Chinese, and that it's a bit of an alarming article. I won't say it changes dramatically. The outlook is just adding another piece to the worries, and perhaps since there's already some uncertainty or some alarm about the commercial real estate elsewhere, it could just add a little bit to that uncertainty and to the negativity. So that is one that perhaps we should keep a distant eye on. And then there's this other one. I don't know if you spoke about it, but ANZ. ANZ is forecasting that the RBNZ will now raise the official cash rate twice more this year. So they're seeing a 25 BP hike in February and another 25 in April. And so that would take the rates from 5.5% to 6%. And that is what caused the big jump in the Kiwi overnight. Was trading around 60.90 or so when it hit, and we went up all the way to this morning nearly 61, 61.5-ish. So that's a full percent move on that, on them sending out that forecast. Now, inflation came down in New Zealand from prior 5 points and a bit, 5.5, 5.6, down to 4.7 or so percent. We know that they had a beat on the jobs number, right? The jobs report coming out like a couple of days ago. But I don't know if I really need to attach like that much credibility to this. We know that Orr is a guy that can do 180 easily from one meeting to another. We have seen it in the past. He has surprised us, where I thought he was rather a bit of a dove. He surprised a couple of times really to the hawkish side. So one completely ruled it out. And on the back of the employment data, we can say that a move like this in the Kiwi would have been justified. But for between that and then calling for another 0.5%, that's 2 hikes, let's call it 2 hikes, seems a little bit far-fetched in my opinion. That's what happened there in the Kiwi overnight. In case people would have missed the reasons why Kiwi is trading a bit higher.
Yeah, it was a bit of a, this is bank forecast. You know my thoughts on bank forecasts.
Yeah,
it wasn't quite a big reaction to that, but was it, who's the other body went hawkish? Conway? I can't remember his name. Conway? I know it begins with C. The one who turned hawkish after that jobs data, or sounded more hawkish after that jobs data.
Yeah. Conway, Longway,
something like that. Yeah, so it's sort of been in the pipe since then, hasn't it? Really. But yeah, I don't know ANZ's record on forecasting, whether they got a good record or not compared to some of the others. But Kiwi, seeing a breakdown on those numbers or from on that forecast. So maybe we're looking to break out this range finally, perhaps this wedge that's been going on. But we shall see. We shall see about that. Right, on to other currencies. Ali, what are you tinkering with today, mate? Oh, you're messing around this 107.70 level. Oof. Every time I've looked at my screen, it's trading at 107.70 over the last few days. It seems to be a little bit of that's where we gravitate to. I've got no change in my opinion from yesterday. You can check back on the show. I said we were still making the lows, but what you want to see is signs that we're stopping. I said after these lows here, even though we failed at up near the big figure 108s, if you're going to see a bottom forming, you want to either see a test of this low and holding, and I actually said, or you want to see it holding up in something like the 30-40 area. And here we have it dipped and held up in the 40 area. So that shows you that buyers are coming in off these lows just to protect those positions. Does it mean we're shooting all the way back to 109? No, but it's an early sign that maybe we've stopped dropping. Of course, go back through 40. Then you'd look at these 20s again. If we fail there, then the trend is going to continue and we're probably on for 107, maybe even worse. From here, it's a bit of a coin toss. We're still holding this support. That's going to be your marker, first of all, for today. 40 is just below that low, Ali. So you want to keep an eye on that. You might get down to, 50s, something like that. If it starts to hold around 50, that'll look like a further step up from that level. So you may want to consider whether you take some profit off the table from that move if the price action says we're not going to have a look down there. Top side, what are you looking at? 108.10. Yeah, you're going to need the break though. You're going to need a move up. So again, if you get up to 108s, 107.90s, and you're not getting through, we're seeing a few, 15-minute hourly candles not getting through. Again, you need to think about it on that side. So yeah, just keep an eye. Your stop is below this low, so that's good. But if you get below there, then we're probably heading all the way back down. So sorry, your stop is at 108.10. So yeah, while we're below 108, then your stop's going to be safe. So yeah, keep an eye on that. Right, what else is going on? Aussie dollar, not a lot going on in that one. Again, similar picture. We did get down through this low marginally, but couldn't quite get back down to this low. So again, the support picture is building a bit here, but you know where the level we need to get through. We need to get through 65.40, and we don't look less bearish until we do that. So it's a bit of paint watching at the moment with all these. We're messing around in 20 pip ranges and whatever. So it's a bit hard to get stuck into anything pretty significant. Gold is one I was keeping an eye on over the Putin interview, as I said, just in case there was any chink of light for the market to grab onto in terms of resolving the risk going on over there. Not a lot. Again, this is another one. Every time we look at it, we're trading at 20.30, it seems. So we're not going anywhere yet for this one. I'm still interested in maybe taking a long down here into this zone, but we're just not getting there. So I'm still sitting on my hands. Same with the top side, maybe looking for a sell up into this big old area, 2075, which goes all the way back as well. We finally got 5K in the S&P. Finally got 5K in the S&P, but it's looking a hard slog at the moment. We're not busting on through. We're not rocketing higher, which, when I look at breaking of levels like that, pretty big levels, psychological levels, we had a period of time here, a couple of days where we banged ahead on it, haven't dipped very far. I would expect that you get a bit more of a blow through, but we haven't seen that yet. So I'm a bit cautious. I do have a buy stop running, but I might change that. I don't know. I might have a little tinker with that and change it around. But yeah, it's not running higher. I guess we'll have to see what the Yanks want to do with it when they come in. Yeah, I wouldn't say we're going to definitely keep piling up here, but yeah, you want to see a bit of support coming in, which we're starting to. I'll just bring it in a bit. We're starting to see a bit of support coming in now, around the 5,000 level, 49.99. So where it couldn't get above, now it's trying to hold above. So that should give it the springboard to continue on up. But personally, I'd like it a bit more explosive than it's showing now. So that makes me a bit more cautious on that. Morning, Dimitri. Late. Where's your note? You got a note from home to say why you're late? We'll look at CAD. I'll let Kay look at CAD in a moment. Yeah, not a lot else going on as far as I'm concerned. Oil again, it's having a little move up. It's keeping this little intraday bullish phase going on, but we're not going anywhere new either. Again, look at the weekend's potential risk from the Middle East and what's going on with US and Iran. Anything springs up there is going to have an impact on oil markets. So again, we've still got this weekend risk to play with if you're trading commodities and whatnot. Gavin, going back to S&P quickly, and then I'll hand it over to the K-Man. Want to see 49.85 hold short term. Yeah, round about there. This low's here. I need to stick a line in there probably. Again, I've been doing this all the way through this move up since the break, just picking up the little levels that are showing up and then adjusting if they don't hold. Like I might pull this one out here, but this one stays in play around 49.37. Another one here yet to be really tested, 49.60s. Although up towards the 70s, it's held around here. So yeah, another little zone in there. And this is all about building up your price picture when you move into areas where there's no historical text to rely on. You can't put a fib against an old move because this is all new territory. You just have to let the price develop and see where it wants to show you where the support and resistance is. So as Gav says, we got 149.85 short-term level. Keep an eye on that. May see some profit taking coming into this weekend. If it gets below there, then it has all the hard work to do next week. But for now, it's trying to hold here. That's good for me for the moment. Okay, you want to have a crack?
Yeah. There's a few things we have to look at for what's upcoming. So let's have a look at them. And one of them is going to be the Canadian jobs report. So I've been looking through those numbers. The Canadian jobs report is always a bit of a question mark, right? Could be volatile, whether it is on the employment change, especially over the turn of the year, but then also in particular on the balance between full and part-time employment, and especially when you get those November, December, January, February data. And now after the pandemic, they have been particularly distorted, of course. Those numbers, especially over the turn. So it's a bit of a question mark today. But if you look at it globally, we are in a bit of a box, right? We've had this big move down on the dollar CAD, then the move higher. We've had this sporadic, opportunistic correlation with oil on and off, but quite hard to trade at times. But really, we are in a bit of a box, which is relatively well defined by the daily cloud, actually, which today the top is around 135.40 and the bottom around 133.40, which is not too far away. That's 133.60 from those prior spike lows. Okay, so that's for the more medium term or so. I want to look at it a little bit shorter, and this is the box. So I was saying like 134 is always going to be a bit of an important level there, and we are seeing it as well. We've had like 1, 2, 3 attempts to trade below, and it straight away rejected this traffic zone. Straight away rejected, and we went back up. The top side is relatively clear. We see bottom here, bottoms around here, top, 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 and that's all happening around 135.40. So on the data this afternoon, if we get a big variation compared to the expectations, that's going to be your top side. That is going to be your initial bottom end of the dollar Canada, and then get a confirmation through this traffic zone, which is probably going to see us drop out of the daily as well if we really get a bumper number, as well with oils trading higher today. That could be the extra push. So that could be the push lower in case we get like really a big number. Now, this is a dollar pair. We also have to know that around 1:30 our time, 8:30 Eastern time, BLS said 8:30, but we always need to take into account that there could be a bit of delay. I don't know about these numbers. They said like 8:30 or from 8:30 or so on their website, but we will have the 2023 CPI revisions coming out today. And looking back a year, that was a number when those revisions came out that threw the transitory into the waste bin for good. And the market is, of course, building a lot of expectations on the back of it, helped by the fact that FOMC's Waller himself said in a prior interview that he was going to look at those revisions coming out today. So the market will react on those, whatever they come out. Even in line, I guess, the market will have a knee-jerk reaction, one or the other side. But the expectations are for having much less, much less variation compared to what the prior or the initial data showed us. So I'm still not convinced that in stuff like euro dollar cable, also Aussie dollar, still not convinced that at the end of the day, we are really going to break levels, providing those numbers come out in line. But be careful, because we can have volatility around 130. And then looking back at this one, we could have a double whammy somewhere. If you have a bad jobs report, and you get higher revisions of last year's CPI, this could actually go for a thorough test of this 135.40, of course. If in turn you get a bumper report and CPI, which will be the surprise trade, by the way, if it comes out lower, if the CPI is revised lower, this could go for the real test of these lows here. So having a position right now in the Canadian dollar is a bit of a flip the coin. Versus dollar, at least. If you look at the other cross, which I am keeping a close eye on. Yesterday, I tried to trade this break and then gave up on it just for virtually the brokerage and a few pips to the sharks of this FX ocean. This EuroCAD, in my opinion, is looking to break. And I do agree with the view of some people here that I see very little reason, barring that the differentials are holding up for the euro, and okay, the employment data are still doing all right, and perhaps the market is hoping for European data to stabilize. But I see very little reason to be long euro. Let's put it that way. And this one is still on my radar. We're turning around. If you get a good Canadian labor report, this may be one that is breaking down. This is one that I'm looking at still. Okay. If you get a bad report, then we're probably going to trade a bit higher than where those rebounds, very shallow rebounds, were so far. So perhaps back up into those high 145s. But if we get a really good report, this one is one that is going to be on my radar. Yen, quick look. We are trading around the 78.6 of this move lower. This one from the highs in November up. And then, but we have to take this one into account as well, because we had this first leg lower. And you remember in November, there was the stock markets were absolutely roaring higher, right? So we had the euro dollar, the cable, and all those things were already turning, and the dollar yen took much longer to turn. The rest started to turn really here on this first leg lower. But then we had this first leg lower. Then the crosses in the yen continued to go higher. But here, look at this. The several attempts to get back above 150, but it failed around 149.75. We are very close. I think if we don't get any dramas on those CPI revisions this afternoon, looking at how mellow Ueda was, I think we're in for a decent test of that zone. And this is then this zone here really is the gateway to me to get back up at 2 or above 150 really. Unfortunately for yen bulls, the Bank of Japan members are not really helping them right now. And then you look back at how much it costs to be long yen. That just keeps me in the camp of being very cautious towards the yen. Yeah, we are seeing moves lower, but it came back really really easily as well, right? So that's still. I think until the next Bank of Japan meeting, this is one that I'm really not going to fight. I'm actually more in very quick scalps to the long side than rather fighting this move. On the Swiss, because we have to talk about the Swiss because it finally. Well, that's sterling Swiss. Sterling Swiss is banging its head. Actually, by the way, sterling Swiss is banging its head against this 110.50.60 for the time being. So for those having that in position, this is one that needs to give way. Even though the break here and that support is holding, we really need to break to get to higher levels. But we need to talk about the dollar Swiss because this is one that a lot of people are keeping an eye on, of course. We finally got the break above the daily cloud, and that is positive for now. Now we need to wait to see what those revisions are going to be in the CPI, but this is going to be basically my first measure point to close the week. We are on a Friday, close the week above, it's probably going to be positive. Close the week below, then we're going to have to look at what's happening around 86. Call it 70, 85, okay? I'm still running my options. I'm still positive towards this, and that's as much as I have to say about it. It's looking pretty okay. Every morning when we get in this week, it does look like there's a few Swiss sellers around, so that I would say as positive as well. But we know US session is very often a different picture than what the European session is doing. So we'll see what those data will bring us later today. And Ryan, I think I've said enough and I've done enough.
Thank you very much, sir.
Oh, cable, yeah. Brand wants to look at the cable if you want.
Yeah, go ahead, mate. I'll grab it quickly.
Yeah.
Yeah. Just quickly to Ali. Just you're talking about euro dollar and why euro strength is justified, and then you go through, ECB is signaling cuts, signaling no cuts. Again, it's context, mate. Context. Here's the chart on the week. You could say it's a bit strong. Okay, it's not gone down anymore. Look at the context for the year. Let's go on to a daily. What have we seen all year? All year we've seen it coming down. Oh, sorry, where are we? Yeah. So all year, you can't say that's strong on the year because it was up here, now it's down here, and then let's go even further out. Is it strong compared to where we were here? No, it's much weaker. Come all the way out. Does that say that the euro is strong at the moment? So your context is needed. Just because it looks strong on a day doesn't mean you can't use your explanations for intraday pricing. You have to look at it overall, and overall you have to get whether the currency is stronger or weak on a different time frame. This move here, all of 2024 so far, is based on your theory that the ECB is signaling cuts and the Fed is signaling that it's higher for longer. That's your move, not what's happening intraday, mate. So just adjust your context in terms of thinking about strength and weakness of a currency. Know where and when it's strong and weak. Cable, okay. What have we got to show about cable? So it's getting a bit messy around this 126 at the moment. We have topped out 126.40, which a bit of an old area of support. So that's the area to look at on the top side. Very similar to tapping up near 107.80s, 90s in euro dollar. Similar theme, hit a low, bounced, came down, not quite the same, couldn't quite get back down to that low, so we're finding support coming in again. 126 still looks like it's a bit of a pivot here at the moment. We're testing it just now, but we're not seemingly looking like we can hold under it for any length of time. That's your key for cable now, Bran. If we get back under 126, start holding under 126, it puts these lows back in danger. Maybe we do get a test of 125. As I said, above 126.40 is just a little intermediate level. And then you're talking about getting up towards the high 126s, maybe tapping on 127. So from here, the jury is out, as we like to say, as what's going on at this 126. If we hold this move now and bounce from here, then likely we'll take out these highs, and we're seeing the stepping up of support coming in. And then, as I say, we'll probably take out these highs and we'll see where we go to next. But I know you've been looking at the short side from this one, Bran. So if you are shorting, you know where your pain level is. You don't want to be shorting here against 126. You want to be shorting a confirmation hold of 126, but keeping your risk fairly tight if that's what floats your boat, mate. Right, on that note, we shall call it a day for today. Thank you, as always, for coming to the Flow Show this week and supporting us here. We do appreciate all your viewership and your comments and your input to that. We thank you for that as well. And hopefully we'll see you all next week. Thanks, as ever, to K-Man for keeping me company and adding his wonderful stuff to the conversation, analysis and charts and whatnot. Have a great weekend, everybody. Stay safe.
Everybody. Thanks, Ryan.
Cheers, mate. Have a good one all, and we'll see you next week.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.